So far, in the first 2.5 decades of this 21st century, things have been up and down in the US stock market and the global economy. Already, 2 recessions and a global pandemic have rattled the financial markets of the world. Therefore, it's crucial to reflect on what we have learned in this new century. In today's video, we will look at what the greatest investor in the history of the world, Warren Buffett, says he has learned during this new century, and how we can apply all these learnings to our own investing strategy in the ever-changing area of investing and the volatile financial markets of the 21st century. Before we get into Warren Buffett's learnings over the last decade, if you like our cutting-edge investment content curated by professionals with decades of entrepreneurial and investing experience, consider subscribing to our channel and join in on our alerts so you never miss our new content. It should be of no surprise to anyone that this 21st century has been wild. But what exactly did it teach Warren Buffett? These are a few things he has shared. Number 1. Be open to learning new things. Quote, "In my whole life, I have known no wise people over a broad subject matter area who didn't read all of the time. None. Zero." End quote. Charlie Munger, self-made billionaire and Warren Buffett's longtime business partner. So why are all of these wise people reading so much? And what do they know that others may not? It's a simple answer. Learning is the single best investment of our time that we can make. And, as Benjamin Franklin said, an investment in knowledge pays the best interest. Over a lot more than just this 21st century technology has been rendering very expensive products to be cheaper or even free. Automated vehicle fleets and self-driving taxis will potentially eliminate one of our biggest household purchases, a car. While costs for education and healthcare have risen and stayed, very high technology is very likely to demonetize these areas as well as in the near future. While goods and services are being demonetized, knowledge is becoming increasingly valuable. A possible area where this can be best seen is in the rising value of knowledge in the self-driving auto industry. GM acquiring Cruise for $1 billion and Uber paying $700 million for Auto, which was only a 6-month-old company at the time of acquisition. The going rate for talent in this industry is $10 million per skilled worker. Those that work really hard throughout the career but don't make an effort and take the time to learn new things could become an at-risk group. Those stuck on the bottom level of global competitive output risk losing their jobs to automation, just as blue-collar workers did between 2000 and 2010, when robots replaced 85% of manufacturing jobs. Number 2. Don't borrow money to buy stocks. Quote, "It's insane to risk what you have and need for something you don't really need. You will not be way happier if you double your net worth." End quote. Warren Buffett. To borrow money and put this into assets that have tremendous risk is not a good idea, according to Warren Buffett. A lot of investors do it, but that doesn't mean it's a good idea. Another popular quote from Warren Buffett on this subject is, "When the tide goes out, we will all see who is swimming naked." He just means that when the general stock market goes down, we will all see who has purchased their stocks and investments on margin. Margin means borrowing against the values of the securities in your brokerage account so you can purchase more securities. Most brokerage firms will allow you to borrow against the values of your other securities or investments. If you purchase your stocks and securities on margin and the prices of your investments goes down, and your net equity in your underlying securities fall below the minimum requirement of your brokerage firm, you will most likely receive a margin call. This margin call will require you to bring in a certain amount of cash or sell a certain dollar amount of securities. If you don't do either of these, the brokerage will sell your investments on their own. A profound example of using too much margin or leverage was the collapse of the Lehman Brothers, who filed for bankruptcy on September 13, 2008. Just prior to their bankruptcy filing, their leverage was 31-1. Meaning their net equity was only approximately 3% of the value of their holdings. Number 3. The scuttlebutt method works. To Buffett, this is a classic. This method entails talking to members of a company, its investors, and their rivals, and using this information to assist you in your investment decisions. Buffett used this for when Berkshire Hathaway first purchased Apple in 2016, and it worked like a charm. The scuttlebutt method is applicable at all times, as it is simply thorough research. Invest in good businesses, not just in good ideas. In the tech world, startups come and go. Some emerging companies rise to the top and others fade away into oblivion. It's not like those that didn't succeed didn't have a good idea. It was their lack of execution that caused them to fail. As an investor, you must have a precise understanding of the fair price of the business, but also their ability to execute. But how will you know if it's a good business? You'll need to talk to their employees, other investors, and most importantly, their customers and competitors. Gauging the responses of their competitors and customers will be very important in showing you just how good of a business it is. Most companies love talking about their competitors, either to downplay them or to show that they are just as capable. It is also likely that a business competitors are the most likely to have the most detailed information about their capabilities. Number 4. Don't bet against technology. In general, any new technological product that is being rapidly adopted by the masses is likely to be a growing company, thus good to consider for an investment. Technology is constantly improving and changing the world in certain ways, and it is incredibly clear that technology is a superior investment vehicle when you look at the US equity indexes over the 21st century. Technology stocks drastically outperformed in the broader market, the S&P 500, over just the past decade. The tech-heavy NASDAQ 100 index gained over 356% in value compared to the 160% rise in the S&P 500 index. So, as you may guess, it would be unwise to not seriously consider the emerging AI industry. It's not a good idea to bet against emerging technology. Thank you for watching. Tell us what you think about what Warren Buffett has learned in the 21st century by leaving a comment in the comment section below. If you like our cutting-edge investing content curated by professionals with decades of investing and entrepreneurial experience, remember to like this video, subscribe to our channel, and join in on our alerts so you never miss our new content. Oh, and check out our other popular video on the screen.